Welcome to the deep dive, where we really try to cut through the noise. We want to transform complex information into clear, actionable insights for you.
Mhm.
Today, we're plunging into a day that was, well, anything but ordinary in the financial markets.
Yeah.
We're looking at Wednesday, August 20, 2025.
Right.
It was a day brimming with, stark contrast, some really intriguing numbers, and honestly, a whole lot of questions that are still kind of echoing across trading floors.
Absolutely. A really pivotal day.
Our mission for this deep dive is to go far beyond just the fleeting headlines. We want to meticulously unpack the raw data, the precise statistics that truly shape the market on this particular day.
Get into the nitty-gritty.
Exactly. Think of this as your shortcut to understanding what's really driving the biggest trends. We hope to offer you a concise yet comprehensive grasp of the financial landscape. We're drilling down into a crucial report titled End-of-Day Market Analysis. August 20, 2025, Tech's AI reality check deepens ahead of Jackson Hole.
Yeah, that report really captured the mood.
And we're not just going to tell you what happened. We want to explore why it happened and what these, intricate statistical movements might mean for you as you navigate this dynamic economic environment.
Okay, let's unpack this together.
Sounds good. And what's truly fascinating here, I think, is how the numbers from just this single day paint such a layered, almost you could say paradoxical picture.
Mm-hmm.
It's like watching a complex financial detective novel unfold in real time, isn't it?
Yeah, that's a good way to put it.
We're witnessing a market attempting to navigate a pretty treacherous path.
Mm-hmm.
It's caught between a significant reevaluation of its most dominant technological trend.
Whole AI thing.
Right, the AI reality check. And then the looming shadow of crucial monetary policy decisions, Jackson Hole.
Looming large.
Exactly. It's a textbook example, really, of how these big macroeconomic shifts and the sort of micro-level corporate realities collide. And they create a truly unique and, frankly, challenging landscape for investors. The fractured market. An overview of August 20, 2025. That's a perfect way to set the stage. When we scrutinize Wednesday, August 20, 2025, the U.S. equity markets were, undeniably presenting a fractured and inherently cautious front.
Yeah, fractured is the right word.
The prevailing sentiment was one of sort of subdued anticipation. I felt like the entire market was collectively holding its breath, waiting for the next shoe to drop.
Definitely waiting for Powell.
Absolutely.
Yeah.
And we observed a really clear and, I think, compelling divergence in performance across the major indices. On one side, we had a deepening sell-off in the technology sector. That trend significantly impacted both the NASDAQ Composite and the S&P 500.
Pulled them both down.
Right, pulling them into their second and fourth consecutive losses, respectively. It was a clear sign of weakness in an area that had seen, immense growth.
Almost unstoppable growth, it seemed, until then.
But then, on the entirely opposite side of the spectrum, the Dow Jones Industrial Average, that index of 30 big blue-chip American companies, it actually demonstrated remarkable resilience. It managed to end the day with a marginal gain, which is pretty striking in context.
It really is. That contrast tells a story.
And this stark contrast wasn't just some random fluctuation, right? It highlighted a significant, deliberate flight to value in the market as investors sought refuge in more stable, established companies.
Yeah, moving away from growth, looking for safety.
So what exactly were the major forces at play driving this pronounced divergence?
Well, two colossal forces really dominated the day. First, there was that mounting wave of skepticism over the immediate, tangible profitability of artificial intelligence. Generative AI, specifically.
The show me the money moment for AI.
Exactly. It began to seriously challenge those previously stretched tech valuations. The market was essentially asking, okay, where's the actual profit here?
Big questions being asked.
And second, virtually everyone in the financial world was fixated on, and frankly, maybe a bit anxious about, Federal Reserve Chair Jerome Powell's highly anticipated keynote address. That was coming up at the Jackson Hole Economic Symposium later in the week. Yeah, Jackson Hole always carries weight. Historically significant for policy signals.
It really does. Its shadow loomed large over everything. And just to add another complex layer to this already intricate picture, we also got a mixed bag of earnings reports from major retailers.
Right, the consumer picture wasn't simple.
No, it painted a pretty divided and nuanced picture of the American consumer's health. It wasn't all strong, nor was it uniformly weak. Kind of messy.
You've perfectly articulated the core dynamics there. And if we connect these seemingly disparate elements to the broader financial picture, they actually weave together. They form a very coherent and compelling narrative when you examine the raw numbers, the stats, in detail.
Okay, let's do that. Let's dive into those specifics from August 20th.
Right, because the precision of these statistics tells us so much. So the Dow Jones Industrial Average, DJA, as you noted, closed at 44,938.31.
Okay.
Now, this represented a marginal gain, just 16.04 points, or a minuscule plus 0.04%.
Tiny move in percentage terms.
Tiny. But while that percentage might seem small, its significance is, well, profound in context. This seemingly minor gain signals a remarkable underlying resilience, especially given the broader market weakness. It indicates a clear and conscious rotation of capital towards what investors perceive as safer or value stocks. You know, companies with established business models, consistent earnings, often less sensitive to economic downturns. It's a defensive play.
Moving to safety. Got it.
Now, in stark contrast, the S&P 500, SPX, it's a much broader index, 500 of the largest U.S. companies, it closed at 6,395.78.
And that was down.
That was down, a decline of 15.59 points, or a minus 0.24%. What makes this particularly noteworthy is that it marked its fourth consecutive day of losses.
Okay, 4 days straight. That's significant.
It is. It's its longest losing streak since early August, and it truly indicates a broader market pressure. But, and this is absolutely crucial, this pressure was primarily, almost overwhelmingly, due to its heavily weighted large technology components. They basically pulled the entire index down.
The market cap weighting effect.
Precisely. We'll come back to that. Then, the NASDAQ composite, IXIC, as you'd anticipate, was the most impacted index. It closed at 21,172.86, down a substantial 142.10 points. That's a now 0.67% decline.
Ouch. The tech barometer.
Exactly. This index is heavily skewed towards technology and high-growth companies, so its performance is a direct, undeniable reflection of the acute pressure building up in that specific sector.
Okay, so equity's showing that clear split. What about bonds?
Good question. Moving from equities to fixed income, the 10-year U.S. Treasury yield saw a slight dip. It fell to 4.296%, down 0.006 percentage points.
Because its yield's down.
Yields down. This drop is a classic indicator, often suggesting that flight to safety we talked about.
Right.
Investors feeling uncertain about stocks often reallocate into U.S. government bonds, which are seen as super safe.
Right. More demand for bonds pushes yields down.
Exactly. Increased demand, higher prices, lower yields.
And the VIX, the fear gauge.
Yes, the CBOE Volatility Index. It remained elevated, near 16. It had actually closed the prior session at 15.57, marking a 3.9% increase. So its sustained elevation signals a notable increase in investor anxiety.
Makes sense.
And importantly, it shows a growing demand for portfolio protection. When the VIX is high, it means the cost of insuring portfolios using options trading is going up. It reflects a palpable sense of unease. People are paying up for insurance.
Okay. What about commodities? Oil and gold.
Also interesting movements there. WTI crude oil, CLSCP25, that's a U.S. benchmark. It actually settled higher at $63.14 per barrel. That was a gain of 1.01%.
Huh. Oil up despite the caution elsewhere.
Yeah, a bit counterintuitive maybe.
Yeah.
But this upward movement suggests that traders still hold a belief in, intact global demand for energy. Plus, there are ongoing supply-side dynamics supporting prices.
So not a total economic panic signal from oil.
Not necessarily, no. And finally, gold futures, GC, climbed to $3,385.20 per ounce, rising 0.8%.
Gold doing its usual safe haven thing.
Pretty much. Gold's traditional role as a safe haven asset was certainly at play. Plus, that slight dip in treasury yields we mentioned, that helps gold too.
How so?
Well, it reduces the opportunity cost of holding non-yielding gold.
Oh.
If bonds aren't paying much, holding gold, which pays nothing, becomes relatively more attractive.
Oh, okay. Makes sense.
So when we connect all these statistical dots, the Dow's resilience, the tech-led declines in the S&P and NASDAQ, the flight to safety in treasuries and gold, and that rising VIX, they paint a remarkably coherent picture. They show a market in active flux. Capital is being strategically reallocated. Investors are moving away from higher-risk, growth-oriented assets like many tech stocks.
Taking profits there.
Exactly, taking profits, reducing exposure, and deliberately shifting towards more stable defensive assets. This isn't a widespread indiscriminate panic. Rather, it's a calculated de-risking, a repositioning ahead of clearer economic signals, and crucially, the Fed's upcoming words. 2. Benchmark index performance. A tale of two markets unpacked.
That's an excellent deep dive into the raw numbers, and it really sets the stage perfectly for what happened within the core benchmarks themselves. Because, as you've highlighted, August 20th presented a tale of two very, very different market experiences.
Absolutely, like two different markets operating on the same day.
Let's start with the Dow's quiet strength. So on August 20th, the Dow Jones Industrial Average eked out that small but significant gain of 16.04 points, closing at 44,938.31.
Right.
And this wasn't an isolated event, right? It marked its second consecutive day in positive territory. And remarkably, it was its fourth highest close in history.
That's quite something.
To put that in perspective, the Dow was just a mere 0.17% off its own record close of 45,014.04, which it had set way back on December 4, 2024.
Practically knocking on the door of its all-time high.
Exactly. This performance is quite remarkable, especially when you contrast it with the weakness elsewhere. It undeniably demonstrates underlying strength in the more traditional non-tech sectors of the economy.
Yeah.
So what was really driving this quiet resilience?
Yeah, that's the key question, isn't it? Why did the Dow show such resilience when other broader indices were faltering, retreating? It's a clear and statistically significant indication of that rotation we mentioned, a rotation into more traditional, value-oriented blue-chip names.
The classic Dow stocks.
Exactly. Established companies, often household names, mature business models, more stable earnings streams, maybe paying dividends. Think sectors like industrials, financials, healthcare. They make up a larger chunk of the Dow compared to the tech-heavy NASDAQ. These companies are generally less sensitive to those high-growth, high-valuation pressures that were just hammering the tech sector at the time. Their stability essentially insulated the 30 stock index from that tech-centric turmoil.
Acting like a relative safe haven.
Precisely. And just a minor statistical nuance here for the real data geeks. While we're using the final closing value of 44,938.31, some preliminary reports initially showed it a bit higher, around 45,069.09.
Okay. Little fluctuations at the close.
Yeah, it just underscores why it's vital to rely on the final confirmed data when you're doing this kind of deep dive analysis. Precision matters.
Absolutely. Now, let's turn our attention to the S&P 500. This one offers a much more complex and, frankly, almost deceptive story.
Yeah, the S&P is where it gets really interesting under the hood.
So this broader market benchmark, 500 leading U.S. companies, it fell for a fourth consecutive trading day. Shed 15.59 points to finish at 6,395.78.
That losing streak, its longest since early August.
Right. And it represents quite a swift reversal of sentiment, especially considering the index was just, 1.12% off its record high, which it had set only a week prior, on August 14th.
So close to the peak, then 4 down days.
Exactly. So on the surface, this looked like a pretty broad market pullback, maybe indicating widespread weakness across the board.
Right, and this is where it gets really interesting. This is a crucial aha moment for you as a listener, I think. The S&P 500's headline decline, while appearing to signal broad market weakness, actually masked surprising underlying strength in many other areas of the market.
How so?
The fundamental reason lies in the S&P 500 structure. It's market cap weighted.
Right. The bigger the company, the more influence it has.
Precisely. Companies with larger market caps, like those mega cap tech giants, NVIDIA, Apple, Microsoft, Amazon, they wield an enormous, disproportionate influence over the entire index's performance. Their sharp declines on August 20th and in the days leading up to it were so significant, so weighty, that they were sufficient to pull the entire S&P 500 into negative territory.
Even if other stocks were doing okay.
Exactly. Even as a substantial number of other constituent stocks held their ground, saw marginal gains, or even advanced quite nicely. It's like, imagine a giant ship being steered by just a few massive engines. If those big engines suddenly lose power, the whole ship slows down, even if the smaller engines are still chugging along just fine.
That's a great analogy.
So the key takeaway is, the index's headline performance doesn't always tell the whole story of how the average stock or the majority of companies are actually performing. It's a critical statistical nuance. You have to look deeper than the headline number.
Okay, that's super important context. And then we come to the NASDAQ. The tech-heavy NASDAQ composite truly bore the brunt of the sell-off on August 20th.
No surprise there, given the tech focus.
It fell a significant 142 narrow points, or 0.67%, closing at 21,172.86. And this wasn't just an isolated hiccup either. It marked its second straight day of losses. That brought it to its lowest closing value since August 6th. The index was now, 2.49% below its record high, hit just a week earlier on August 13th.
Yeah, a pretty sharp pullback in just a few days for the Nasdaq.
The numbers here really speak volumes about where the market's pain was most acutely felt.
Definitely. And if we connect this directly to the bigger picture, the Nasdaq's performance is the clearest, most undeniable indicator of that AI reality check we've been discussing. This index is acutely sensitive to pressure on high-growth, high-valuation technology stocks precisely because it's dominated by them. When investors begin to seriously question the immediate, tangible profitability of a dominant theme like generative AI, the Nasdaq is where you see that concern manifest most dramatically in the numbers. It's where the air comes out of the most speculative valuations first. That significant drop signaled a clear reassessment by investors. They were reconsidering where capital should be allocated in the tech space, maybe away from pure speculative potential and more towards proven business models.
Okay, so we've talked a lot about this concept of sector rotation, this strategic movement of capital. But how do we prove this statistically beyond just observing these different index performances?
Great question. This is precisely where the S&P 500 equal weight index comes into play.
The SPXCW.
Exactly. It's a powerful, almost diagnostic tool for understanding what's really happening under the surface. Is the overall market truly collapsing, or is it just a few gargantuan players skewing the main index numbers? The underlying concept here, as you said, is that capital is actively being reallocated. Moving from what we call high beta growth stocks, those that tend to swing more dramatically with the market.
More volatile.
Right, more volatile. Moving from those to more stable, low beta value and defensive sectors.
So the equal weight index gives every stock the same influence, regardless of size.
Exactly. That's the key. It provides undeniable mathematical proof that the market wasn't in a wholesale panic, undergoing some indiscriminate sell-off. Instead, it was undergoing a sophisticated, deliberate reassessment of risk and valuation.
Okay, give us the proof. What do the numbers show?
Right, let me give you the compelling statistical evidence. On the prior day, Tuesday, August 19th, setting the stage for our focus day, while the traditional cap-weighted S&P 500 fell a notable 0.59%.
Okay.
The S&P 500 equal weight index actually rose a significant 0.45%.
Wow. So down 0.6% for the main index, but up almost 0.5% for the equal weight.
Precisely. Now, what does that mean for you as a curious learner? It means that while the headline S&P 500 was dragged down by the immense gravitational pull of a handful of failing tech giants,
NVIDIA, et cetera.
right, the average stock within the S&P 500 index actually performed quite well that day.
That's a huge divergence.
It's a critical statistical signal. It clearly indicates that institutional investors aren't just liquidating everything and fleeing from equities. They are, in fact, strategically rotating capital. They're demonstrating a sophisticated, coherent repositioning of their portfolios, moving from areas of perceived overvaluation and high risk
Like tech.
to areas of greater stability and fundamental value. It's a sign of a rational, discerning market, not an irrational one in panic mode. 3. Primary market drivers. AI reality check and Powell's shadow.
That's a brilliant insight into the underlying mechanics, really revealing how much more there is to a market day than just the headline index numbers. Let's pivot now to the primary drivers behind these movements, because Wednesday's trading was truly defined by two incredibly powerful forces, wasn't it?
Absolutely, a potent combination.
First, that fundamental reevaluation of the tech sector's near-term prospects, particularly around artificial intelligence.
The AI hype hitting a speed bump.
Yeah. And second, a pervasive sense of caution that just blanketed the market ahead of that pivotal monetary policy speech from Powell.
Waiting on the Fed.
This potent combination, as you've pointed out, created a perfect storm for strategic profit-taking in some of the market's most crowded and, until recently, most successful trades.
Definitely. Time to lock in some gains for many.
Okay, first let's dig deeper into the tech tremor. That direct collision of previously stretched valuations and a growing wave of AI skepticism. What was the core evidence there?
Right. The primary catalyst for the widespread tech sell-off was, without a doubt, that growing skepticism regarding the immediate, tangible return on investment from generative AI. For months, the market had been utterly captivated by the potential of AI, right? Driving valuations to frankly, unprecedented heights. But now that narrative is facing a harsh dose of reality.
People asking, where's the beef?
Exactly. And this isn't just an anecdotal feeling. It's backed by some very solid and, well, concerning statistical evidence. There was a recent, widely cited MIT report, for instance.
Oh, yeah, I saw that.
It suggested that a staggering 95% of companies are not yet seeing meaningful returns from their AI investments.
95%. Wow.
Think about that for a moment. 19 out of 20 companies pouring money into AI initiatives are still waiting for a real payoff. That report landed like a fundamental anchor, weighing down investors who had been pouring capital into this space based purely on future, often quite nebulous potential.
Yeah, that'll give anyone pause.
And this report hit a market where valuations were already stretched to extremely precarious levels. To really understand this, let's look at a key valuation metric, the S&P 500's price-to-trailing sales ratio.
Okay. Price to sales, how much you pay for each dollar of revenue.
Right. It tells you how much investors are willing to pay for every dollar of sales a company generated over the past year. On August 20th, the S&P 500's aggregate price-to-trailing sales ratio had hit a record high of 3.19.
Okay, 3.19. Is that high historically?
Very high. To put that into sharp perspective, its long-term average is significantly lower, 1.88.
Wow. Almost double the long-term average.
Exactly. So the market was trading at almost double its historical valuation based on sales alone. Now let's narrow it down just to the information technology sector itself.
Okay, the heart of the AI boom.
Right. Its price-sales ratio was even more extreme. It soared to an eye-watering 9.76.
Nearly 10 times sales.
Nearly 10 times sales. That's almost double its own 10-year average. Imagine paying almost $10 for every single dollar of sales for a tech company.
That sounds rich.
It's very rich. This kind of stretched valuation created an incredibly precarious environment where any negative news, any hint of a reality check like that MIT report, or any more realistic assessment of future profits could and did trigger a sharp and immediate correction. It's like a house of cards, you know? Impressive to look at, but incredibly vulnerable to the slightest tremor.
So it's becoming clear this isn't just about the raw numbers on a balance sheet. It feels like it implies a profound shift in investor psychology, too.
Absolutely.
It sounds like the market is very deliberately shifting its narrative, moving from, the potential of AI is limitless, buy at any price, to a much more demanding stance. Like, all right, show me the profits. What's the actual monetization strategy here? Investors are no longer content with just the promise of future AI breakthroughs. They're aggressively differentiating.
Yes. Differentiation is key now.
Separating companies with a clear, demonstrable path to AI monetization from those perceived as merely riding the hype wave without solid fundamentals to back it up.
Yeah.
How did this actually manifest in some of those high-profile AI-centric names?
Yeah, great question. And we saw this critical differentiation clearly reflected in the declines of specific, previously darling AI stocks. Take NVIDIA, for instance. It's a bellwether for the entire AI chip industry, right? It fell 1.6% on Wednesday, which followed a substantial 3.5% drop on Tuesday. That made it the heaviest weight dragging down the S&P 500 that day.
Pulled the whole index down.
Significantly. Investors are increasingly scrutinizing whether its undeniably lofty valuation trading at approximately 25 times its trailing sales.
25 times sales. Not earnings, sales.
Exactly, sales. They're asking if that valuation has simply outrun its current fundamentals and its actual immediate ability to deliver those promised AI profits. The question has become, is the growth truly justifying that price tag right now?
Okay, so NVIDIA under pressure. Who else?
Another prominent name, Palantir, PLTR, big in data analytics and AI space, experienced an even more dramatic downturn. It tumbled 4.7% on Wednesday.
Wow, almost 5%.
And that extended a week-long slump that had already erased about a fifth of its total market value. It had fallen a sharp 9.4% on Tuesday alone.
Yikes, that's serious volatility.
It is. It indicates that Palantir was a clear high beta target for profit-taking. Now, when we say high beta, we mean a stock that tends to be significantly more volatile than the overall market.
Moves more dramatically up or down.
Right. So if the market goes down by 1%, a high beta stock like Palantir might go down by 2%, 3%, or even more, as we saw here. This kind of rapid, severe volatility, where a substantial portion of value is just wiped out in a few trading days, vividly highlights the speculative nature of some of these AI investments when the sentiment suddenly turns sour.
Got it. So specific AI darlings hit hard? Was it just them or broader tech weakness?
It was broader. Beyond these two specific examples, the weakness was quite broad among the so-called Magnificent Seven names, those stocks that have been the undisputed market leaders for so long. Companies like Tesla, TSLA, Broadcom, AVGO, Apple, AAPL, and Amazon AMZN all experienced declines of around 2% to 3%.
So pretty much across the board for big tech.
Yeah, it suggests a systemic reevaluation of high-growth tech across the board, not just isolated incidents of profit-taking in a couple of names. It's a collective reassessment of future earnings potential, especially in a higher interest rate environment where money isn't as cheap as it once was. Future profits get discounted more heavily.
Right, right. Okay, so that's the tech tremor, the AI reality check. Now let's talk about the other big shadow hanging over the market, Jackson Hole.
Ah, yes, the Fed waiting game.
On top of that persistent tech tremor, a palpable sense of caution just permeated the entire market as investors anxiously awaited Federal Reserve Chair Jerome Powell's highly anticipated speech at the Jackson Hole Economic Symposium.
Everyone hanging on his every word.
Jackson Hole has such a significant historical reputation, doesn't it? It's often been a venue where Fed chairs deliver major policy signals or, hinted future shifts in monetary policy.
It really has. Markets parse those speeches incredibly closely.
So with all the lingering uncertainty around inflation, the strength of the economy, maybe the potential impact of tariffs too, traders were undoubtedly de-risking their portfolios ahead of this absolutely critical event.
Makes perfect sense. Why take big risks right before potentially market-moving news?
Exactly. But what exactly was creating the statistical ambiguity around the Fed's stance that prompted such caution? It wasn't totally clear what Powell would say, right?
No, not at all. And that ambiguity is fascinating. Earlier in the day, on August 20th, the release of the July 30th FOMC minutes set a really complex stage.
Okay, the minutes from their last meeting.
Right. The FOMC, the Federal Open Market Committee, that's the Fed's main policy-making body, the minutes are basically the detailed notes from their last interest rate meeting.
And what do they say? Hawkish? Dovish?
Well, these specific minutes revealed that most officials agreed that inflation risks still outweighed employment risks.
Okay, sounds hawkish. Leaning towards keeping rates higher to fight inflation.
It does suggest a continued hawkish bias. Hawkish, meaning they're leaning towards maintaining tight monetary policy, potentially higher interest rates, to combat inflation. This sounds straightforward, maybe even reassuring to some inflation hawks. But here's the critical catch. These minutes were from July 30th. They predated more recent and frankly weaker economic data, specifically weaker jobs numbers and ISM PMI data.
Ah, so the data picture had changed since the meeting.
Exactly. ISM PMI, the Institute for Supply Management's Purchasing Managers Index, is a crucial indicator for manufacturing and services. Weaker readings suggest a slowing economy. So the market was left with this real ambiguity. What's the Fed's current stance given this newer, potentially contradictory economic data? Were they still as hawkish as they sounded back in July?
Okay, so old minutes sounding hawkish, but newer data looking softer. Creates uncertainty.
Precisely. And despite the seemingly hawkish tone of those July minutes, the market itself was still stubbornly pricing in high odds of a rate cut in September.
Really? Even after those minutes?
Yeah. The CME FedWatch tool, that widely used indicator calculating Fed rate change probabilities from futures pricing, was still indicating an 83% probability of a rate cut in September.
83%. That's a huge disconnect from hawkish minutes.
It's a massive disconnect. This gap between the Fed's communicated stance from prior meetings and the market's aggressive pricing for future policy easing is a key source of ongoing tension and, well, considerable volatility. It's fundamentally a battle of market expectations versus the Federal Reserve's reality.
And everyone was waiting for Powell at Jackson Hole to hopefully bridge that gap.
Exactly.
Yeah.
The market was keenly waiting for Chairman Powell to give some clarity, some signal to resolve this tension. The numbers, the pricing, clearly show this underlying tug-of-war playing out. 4. Sector deep dive. A defensive rotation emerges.
Okay, so we've seen how the headline indices, particularly the S&P 500, can be somewhat deceiving, thanks to that market cap weight of a few mega-cap tech stocks.
Right, the giants skew the average.
But if we peel back another layer and look at the underlying sector performance, what did it truly tell us? You mentioned earlier it revealed a very clear and discernible defensive posture across the market, underscoring just how narrow that tech sell-off really was.
Hmm.
This really brings us back to that powerful mathematical proof we talked about earlier with the S&P 500 equal weight index, doesn't it?
Precisely. The fact that the S&P 500 equal weight index rose 0.45% on Tuesday, August 19th, the day before our deep dive day, but setting the stage while the traditional cap-weighted S&P 500 fell 0.59%.
It's stark divergence again.
It's irrefutable statistical evidence of a deliberate defensive rotation. This isn't just some minor nuance. It means that while the giants of the market were pulling the average down, a significant and broad number of other companies were actually performing well, showing real underlying strength. This dramatic divergence tells us that institutional investors aren't just fleeing the market entirely, convinced of some impending recession. Rather, they are simply and strategically reallocating capital, moving it from one part of the market to another, selectively.
Okay, so let's look at the winners and losers by sector from around that time. Where was the money flowing?
Right, let's look at this specific sector performance data from August 19th because it clearly illustrates the strategic repositioning and reveals the market's, well, intelligent discernment. The best performing sectors were those traditionally considered defensive and critically less sensitive to broader economic cycles or rising interest rates. These are the sectors that tend to hold up better during periods of uncertainty.
The classic safe havens within the stock market.
Exactly. For instance, real estate, XLRE, saw a notable gain of plus 1.8%. This often suggests investors are seeking yield and stability. REITs, real estate investment trusts, can offer consistent dividends and sometimes act as an inflation hedge.
Okay, real estate strong.
Consumer staples, XLP, rose a healthy plus 1.0%. These are companies producing everyday necessities, food, drinks, household goods. Demand tends to be stable regardless of economic conditions, making them a classic defensive play.
People still need toothpaste.
Pretty much. And utilities, XLU, managed a modest gain of plus 0.1%. Utility companies provide essential services. Their revenues are highly predictable, relatively immune to economic fluctuations. Again, a common defensive choice.
Okay, so real estate, staples, utilities leading. Makes sense for a defensive move. What was lagging?
In stark contrast, the worst performer was, predictably, information technology, XLK. It dropped a significant minus 1.8%.
No surprise there, given everything we've discussed.
Right. This sector, being highly sensitive to growth expectations and rising interest rates, which make those future tech earnings less valuable today, suffered the most as valuations were re-examined and that AI skepticism grew. This alignment between the best and worst performing sectors is not random at all. It shows a market that is logically and coherently repositioning its bets, adjusting for a potential economic uncertainty or, at the very least, a shift in the overall investment landscape.
So moving into steadier areas.
Exactly. Investors are moving into sectors where earnings are generally more stable, less tied to economic booms and busts, and often provide consistent dividends. This is a clear statistical signal that the market is acting with discernment. It's attempting to protect capital and reduce risk rather than succumbing to widespread panic. It's a sophisticated adjustment based on the underlying data and the prevailing mood. V corporate headlines, earnings gauntlet, and M&A activity.
Okay, so beyond the broad market movements and those clear sector rotations, the individual corporate headlines on August 20th provided a flurry of specific catalysts. These profoundly impacted single stocks.
Yeah, lots of company-specific news hitting the tape.
We had a heavy slate of retail earnings reports, which, as you mentioned, painted a complex and, importantly, not uniformly weak picture of the American consumer. It really highlighted a discerning, value-seeking shopper, didn't it? Someone who's not just spending blindly, but making very deliberate choices.
Exactly. Not a simple story for the consumer.
So what did those crucial earnings reports truly tell us about the state of consumer health, based on the actual numbers and company comments?
They certainly did paint a nuanced picture. The earnings reports from these retailers, taken together, revealed a consumer who is actively managing their budget. They're prioritizing value, focusing on essential projects or items that offer tangible long-term benefits, maybe cutting back on purely discretionary splurges.
So strategic spending, not just across the board cutting back.
Right. It's not a narrative of universal weakness, but rather one of strategic, thoughtful spending. We saw clear winners and losers based on how well companies catered to this mood.
Let's break that down. Who are the winners? You mentioned value and home improvement.
Yeah. On the winner's side, focusing on value and home improvement, we had TJX companies. TJX. That's the apparent company of TJ Maxx and Marshalls.
Ah, the off-price leader.
Right. Their shares rose a healthy 3.4%. Why? because the off-price retailer impressively beat both profit and revenue forecasts and confidently raised its full-year outlook.
That's strong.
Very strong. They reported a solid 4% rise in comparable store sales for Q2. That's a key metric for retailers, and an impressive earnings per share, EPS, of $1.10, comfortably beating analysts' estimates.
Beating on sales and profits.
Yep. And furthermore, they signaled strong financial health by returning a significant $1.0 billion to shareholders through buybacks and dividends. Their model of offering discounted brand name goods clearly resonated with that value-seeking consumer we talked about.
Makes perfect sense. Who else did well?
Then there was Lowe's, LOW, the home improvement giant. Their shares gained 3%. They reported better-than-expected profit with an adjusted EPS of $4.33 versus a $4.24 estimate. Showed resilience in a tougher environment.
Okay, beating profit estimates.
Right. And on top of that, they raised their full-year sales guidance, showing optimism about continued home-related spending. And strategically, they announced a massive $8.8 billion acquisition of foundation building materials.
Wow, big deal.
Huge deal. Clearly aiming to bolster their business with professional contractors, signaling a pivot towards maybe a more stable revenue stream beyond just the DIY weekend warrior. These numbers and strategic actions collectively showed strength in areas where consumers are either looking for greater value or investing in significant home improvement projects.
Okay, so TJX and Lowe's looking good, but not all retailers fared well, right?
Oh,
Highlighting that divided consumer narrative. Who were the losers?
exactly. On the losers' side, where strategic missteps or demand woes were punished, we saw Target, TGT, their shares plunged nearly 10%.
10%. Ouch. Even though they technically beat expectations.
Yeah, they beat lowered expectations. But the sharp negative reaction was primarily driven by the surprise announcement that CEO Brian Cornell will step down. He's being replaced by COO Michael Fidelk.
Ah, the CEO change spooked the market.
Big time. This unexpected leadership change comes amid a concerning third consecutive quarterly sales decline that clearly unnerved investors despite the earnings beat. The market views leadership changes during periods of fundamental weakness with extreme skepticism.
Okay, so Target punished. Who else struggled?
Estee Lauder, EL, the global cosmetics giant. Its shares fell over 5%. They posted a wider-than-forecast quarterly loss and issued a disappointing outlook, revealed a difficult period ahead.
That was their issue.
The company specifically cited subdued demand in China and the Asian travel retail market as key factors impacting their high-end beauty products. That indicates a shift in discretionary spending habits in those crucial regions, people cutting back on luxury cosmetics. And adding to investor concerns, they also warned of a potential $100 million impact from tariffs in fiscal 2026. That adds a significant layer of future uncertainty and a direct hit to their potential profitability.
Okay, China weakness and tariff worries for Estee Lauder. Anyone else?
And finally, LZB, the furniture company. Its stock plummeted over 12%.
Wow, double-digit drop.
Yeah. They significantly missed profit estimates with an adjusted EPS of $0.47 versus a $1.53 estimate. The company squarely blamed a challenged consumer, indicating broad-based softness in demand for big-ticket items like furniture.
People putting off buying new sofas.
Seems like it. They also pointed to weak store traffic and a substantial 14% sales decline in their contemporary Joybird brand. These specifics really highlight where consumer spending is tightening up, focusing less on large discretionary purchases for the home.
Those individual earnings reports certainly provide a lot of granular detail, a lot of color on consumer behavior, and specific corporate challenges.
Yeah.
But beyond earnings, we also observed other major single-stock movements driven by things like M&A activity or other unexpected surprises, right? Showing how specific news can cause major volatility even within a broader cautious market.
Absolutely. These examples powerfully demonstrate that even within a broadly cautious de-risking market, individual corporate stories can still generate massive, almost independent stock movements. Take Aspen Insurance Holdings, AHL, for instance.
What happened there?
Their shares surged an impressive 16.15%. Why? Reports of takeover talks with the Japanese reinsurer Somco Holdings.
M&A buzz.
Exactly. Analyst reports quickly noted the strong strategic rationale for such a merger. It highlights that M&A activity can often override broader market sentiment and drive significant value realization for shareholders, especially in a sector maybe ripe for consolidation like insurance.
Okay, so M&A driving Aspen up. What about big moves down?
Oh, we had a spectacular one. On the entirely opposite side of the spectrum, James Hardie Industries, JHX, a leading building materials company.
Okay.
They experienced an astonishing and truly brutal collapse. Their stock plummeted a staggering 35.62% in a single day.
35%. What on earth happened?
A disastrous Q1 earnings report. They not only missed revenue estimates, but, critically, issued full-year 2026 EBITDA guidance that was approximately 21% below consensus expectation.
21% below expectations on profit guidance. That's huge.
It's massive. EBITDA earnings before interest, taxes, depreciation, and amortization is a key measure of operational profitability. This kind of severe market reaction to guidance shortfalls, especially such a significant miss, highlights the market's unforgiving nature when growth expectations aren't met, particularly after a period of high valuations in housing and construction. It was a stark reminder of the risks when companies fail to deliver.
Wow. Okay, that's a painful one. Any other notable movers?
And finally, just to show another type of dynamic, we had Newegg Commerce, MEG, an online retailer, computer hardware, electronics.
Oh, yeah, I know Nuke.
Their stock surged a remarkable 24.15%, making it one of the top gainers of the day.
24%. Was there big news? Good earnings?
Not really. This particular move, unlike the others, appeared driven more by speculative momentum and retail investor sentiment than by a specific fundamental catalyst or positive earnings report.
Ah, the meme stock effect.
Exactly. Newegg has gained notoriety for its meme stock status among certain retail trading communities. Coordinated buying activity can rapidly inflate share prices, often completely independent of traditional financial metrics.
So, driven by social media buzz, not fundamentals.
Pretty much. It illustrates that not every significant stock movement is rooted in conventional fundamentals. Sometimes it's pure sentiment, social media speculation, community-driven excitement that dictates price action, especially in a fragmented market like we see sometimes. 6. Cross-asset analysis, bonds, commodities, and volatility.
Okay, so we've thoroughly dissected the equity market, from the broad indices down to individual stocks, sector rotations, exploring all those nuances and hidden stories within the number.
Covered a lot of ground there.
But to truly understand the overall investor sentiment, that collective de-risking narrative on August 20th, we need to look beyond just equities, right? Movements in other major asset classes often corroborate the risk-averse tone we saw in stocks. They tell a single, coherent story of strategic repositioning ahead of Jackson Hole.
Absolutely. You have to look cross-asset to get the full picture.
So what did the fixed income and commodity markets reveal that backed up this story?
Exactly. The story of de-risking and caution wasn't confined to the stock market. It permeated across virtually all asset classes. It signaled a collective repositioning by large institutional investors. Take the 10-year U.S. Treasury yield. We mentioned it dipped. It's a benchmark for long-term interest rates and a key safe haven asset. It ticked lower for the second consecutive day, falling to 4.296%.
Right, the flight to safety we discussed.
This movement is entirely consistent with that dynamic. When investors are uncertain or nervous about stocks or the broader economy, they often flock to the perceived safety of U.S. government bonds. This increased demand drives bond prices up and, consequently, pushes their yields down. Direct inverse relationship.
Anything else in bonds? The yield curve.
Yeah, good point. We also observed that the yield curve, specifically looking at the spread between the 10-year Treasury yield and the 3-month Treasury yield, remained stubbornly near zero, almost flat.
And that's a recession indicator people watch closely, right?
It's a historically reliable recession indicator. Its persistent flatness, or sometimes inversion, where short-term rates are higher than long-term, is something financial markets monitor very, very closely for any early signs of economic distress or slowdown. So its state on this day added to the cautious undertone.
Okay. Now, commodities again. Gold and oil. You mentioned gold was up, acting like a safe haven.
Right. Gold, the traditional safe haven asset, benefited significantly from this environment of uncertainty. Spot gold, the price for immediate delivery, rose 0.8% to $3,341.56 per ounce, with futures trading slightly higher near $3,385.
And that was driven by the uncertainty and lower yields.
Primarily, yes. It gained from two key factors. First, that slight dip in Treasury yields, which reduces the opportunity cost of holding non-yielding gold, making it relatively more attractive compared to bonds. And second, just its long-standing role as a reliable store of value during times of economic or geopolitical uncertainty. That definitely pushed its price higher. Classic safe haven behavior.
Okay. But oil was also up, which seemed a bit different.
Yeah, WTI crude oil front-month futures rose over 1% to settle around $63.14 per barrel. Now, as we said, this might seem counterintuitive given the cautious equity market sentiment.
Right. Why would oil go up if there's economic uncertainty?
Well, this upward movement reflects a persistent belief among many traders that global demand for oil remains largely intact, despite pockets of economic weakness or the tech sector's specific struggles. It also points to ongoing supply-side dynamics, think production cuts by major oil-producing nations, which are supporting prices.
So it indicates that while there's a targeted reassessment of risk in tech, there isn't necessarily a uniform fear about a total collapse across all sectors of the global economy.
Exactly. The market is being selective. Oil traders weren't seeing the same level of immediate threat as, say, tech investors were.
Okay, that makes sense. And finally, let's circle back to the VIX, our critical fear gauge. It stayed elevated.
Yes, it continued its recent ascent on August 20th, providing crucial statistical insight into that investor anxiety we felt. After closing the previous session at 15.57 with a 3.9% increase, the index remained elevated, hovering around the 16 level throughout the day.
So no relief on the anxiety front.
No relief. This sustained elevation is a clear and statistically significant signal of a notable increase in investor anxiety and, importantly, a rising demand for portfolio protection.
People buying insurance.
Exactly. When the VIX is up, it means the implied volatility of options on the S&P 500 is higher, making those options more expensive. Traders are actively buying these options, particularly put options, to hedge against potential downside moves in their portfolios. This reflects a cautious, uncertain, and defensive outlook that pervaded the entire market, perfectly corroborating the moves we saw across equities and fixed income. It all ties together. 7. Concluding analysis and forward outlook.
What an incredibly detailed and coherent picture you've painted there, really extending beyond just the surface numbers and connecting all the dots. So to bring it all together, Wednesday's session on August 20th, 2025, truly felt like a crucial chapter in the market's rapidly evolving narrative for the second half of the year.
Yeah, a real turning point, potentially.
The unbridled optimism, that seemingly limitless potential that had propelled the AI-centric rally for so long, it now seems to have definitively met a formidable wall of skepticism.
The hype met reality.
And the skepticism, as you've pointed out with those staggering price-to-sales ratios, is deeply grounded in very real concerns over actual profitability and sustainable valuation. It's not just vibes, it's based on numbers.
Right. Valuation matters eventually.
What's more, this significant micro-level shift in the tech sector was powerfully amplified by that macro-level environment of peak uncertainty, with virtually all eyes turning to the Federal Reserve and its upcoming pronouncements from Jackson Hole.
The micro and macro feeding each other.
Exactly. So if we connect all these statistical threads to the bigger picture, what's the final takeaway on the market's behavior?
Well, if we connect all these threads, the resulting divergence between the tech-heavy NASDAQ and the value-oriented Dow, coupled with that clear and undeniable rotation into defensive sectors, it signals a mature and discerning market.
Not panicking, but thinking.
Exactly. It's a market that is actively and intelligently repricing risk. It's skillfully differentiating between areas of genuine, sustainable growth and those areas that might have been dangerously overheated by pure hype and speculation. This isn't a sign of irrational panic or a market losing its way. It's a logical, statistically driven response to new information, a reevaluation of current realities, and, of course, the looming shadow of significant policy decisions.
Okay, so for you, the curious listener, as you put it, what's a key statistical indicator to watch closely now coming out of this?
Good question. For you, the curious learner, a key statistical indicator to watch closely now is the S&P 500 testing its 20-day moving average. At that time, it was sitting precisely around 6,380.
Okay, the 20-day moving average, a short-term trend line.
Right. A moving average is essentially a continuously updated average price over a specific period, and the 20-day is a widely recognized short-term indicator of trend and, crucially, support. This 6,380 level acts as critical short-term support.
So what happens if it breaks below that?
A sustained break below that level could signal further downside momentum. It might potentially extend the current correction, indicating that the shift in sentiment is gaining significant technical traction beyond just the immediate headlines. It's a number many analysts will be watching very closely.
Absolutely. And looking ahead from that day, the market's trajectory for the remainder of the week and likely into the next seemed almost singularly dictated by the events unfolding at Jackson Hole.
Completely. Federal Reserve Chair Powell's speech on the Friday was truly the critical data point everyone was waiting for. Its precise wording, its tone would have immediate repercussions.
So what were the concrete stakes for investors? What were the potential scenarios?
Well, there were two primary distinct scenarios we could envision, each with very different market implications.
Okay, scenario one.
Scenario 1, a dovish pivot from Powell. where he acknowledges the recent economic softness, maybe hints at concerns about the tech sector's struggles, and signals a clearer, more immediate path to interest rate cuts.
What would that do?
That could very well reignite the tech rally and provide a much-needed boost to broader market sentiment. Cheaper money historically fuels growth stocks.
Okay, so a dovish Powell could rescue tech. Scenario 2.
Scenario 2. A hawkish stance, one that strongly emphasizes persistent inflation risks and actively pushes back against the market's aggressive expectations for easing for those rate cuts.
And the impact of that.
That could certainly extend the current correction. It could potentially deepen the sell-off in growth-oriented sectors as investors grapple with the reality of higher for longer interest rates.
Okay, so high stakes depending on Powell's tone. Okay, anything else to watch?
Yeah. Beyond Powell's words, traders would also keep a close eye on other upcoming economic data, the next PMI readings, existing home sales data for further clues on the broader economy's health and direction. Every data point contributes to the bigger picture, feeds into that Fed calculus.
Ultimately, then, it really feels like the market on August 20th had definitively moved from a phase of buying the story, particularly the AI story, to one of demanding the proof.
Perfectly put. Show me the money.
Right. This applies both to corporate earnings in the AI space, where investors now want to see actual monetization and clear paths to profitability, and to a potential dovish pivot from the Federal Reserve, where they're looking for concrete signals and actions, not just hints or, ambiguous Fed speak.
Yeah, no more reading tea leaves. They want clarity.
The coming days from that point certainly looked set to test the resolve of both the bulls and the bears as this new, more skeptical, and definitely more statistically driven paradigm took hold. So as we look back at August 20, 2025, and ahead to what's next from that point, maybe a final thought. What do these intricate numbers and precise statistical shifts truly tell us about the future of innovation? Will the pursuit of groundbreaking AI continue to dominate the market narrative based purely on potential? Or will profitability finally be the ultimate undeniable metric?
That's the billion, maybe trillion-dollar question.
And how will the Federal Reserve balance its dual mandate price stability and maximum employment with the market's undeniable, almost insatiable hunger for easier money?
The constant balancing act for the Fed.
Keep observing these key indicators because understanding these underlying statistics and their implications is truly the real superpower in navigating market complexity and making informed decisions.